Welcome to OptionTiger.com. My name is Harry Swaminathan. In this video, I want to show you a couple of examples of a bull call spread and just explain the subtleties of the choice of strike prices that you make when you put a bull call spread. So a bull call spread is you're going to be long a certain call option and you're going to sell another call option at a higher strike price. So what we're looking at is Apple. Apple's at 428 and we're looking at the May series, which has 64 days to expiry. So you can put a bull call spread a couple of different ways. You can construct a bull call spread, let's say at the 425 level. You buy the 425 call and you sell the 435 call. So it's a $10 wide spread and you're going to pay $4.73 as a debit for this spread. Now you can see that the 425 call is already in the money because Apple is above 425 already. It's at 428. So one of the good things about this kind of a spread is that you'll find that the bull call spread is theta positive. And that's because the 425 call has lesser theta decay than 435. So you actually have a theta positive trade. So let me put up the intrinsic and extrinsic value for these options. And what you'll see is that the extrinsic value of the 420 call is $17.30, whereas the 425 call is 19.625, and the 435 call is 19.9. So you can see that the extrinsic value of the 435 call is more than the extrinsic value of the 425 call, and that's why you're seeing a theta positive. So, being theta positive on a bull call spread is rare unless you construct a spread where your long call is in the money and your short call is either at the money or slightly out of the money. And if you look at the extrinsic values, if the extrinsic value of your short call is more than the extrinsic value of the long call, then you're going to be theta positive. So that's the advantage. What are the disadvantages of this spread? The disadvantages is, first of all, you're going to pay $4.73. So on a $10 wide spread, that's almost 50%. So, in general, if you want to put a bull call spread, you're expecting a reward to risk ratio of slightly more than that. So the other option, and this is the general case, most people will tend to put a bull call spread, which is out of the money. And so what you'll see here is something like this. So let me add another trade. Let's say we add 435. Well, let's say we're buying a vertical. So 435, let me see that. 435 and let's say 445 just to keep the spread even at $10. You can see now you're going to pay much less, but you're going to be slightly theta negative because your 435 call has more time decay than 445. So these are the two spreads, and in general, people would choose the out of the money, and in many ways that makes sense. But probably you may not have thought of the extrinsic values, and that's what I wanted to show on this video. But there's another subtle advantage that you have to consider. So, which is, let's say you got the move, and Apple went from 428 to 435. So in that case, so Apple makes a move of $7. So in which case, both your bull call spreads will be doing well, which means you'll have a profit. But let's look at the subtleties of both these spreads and try to understand what will happen to either one of these spreads if Apple moves to 435. So in the first case, if Apple moves to 435, so we are looking at the in the money bull call spread. So we have the 425 call, which is already in the money. If Apple goes to 435, then your 435 short call is going to be at the money. And your 425 call, which was already in the money to begin with, is going to be further in the money. But your 435 call is going to be at the money. And at the money means, so that's similar to either your 425 or your 430 right here. And you can see that the extrinsic value of the at the money option, so it would be exactly like this 430 call. So you can see that the extrinsic value of the at the money options are going to be the maximum. And that's your short call. So your long call is already in the money and it's going to be further in the money. Your short call, which was out of the money, is now at the money. So being at the money is going to have the maximum extrinsic value. And so when we execute a spread, what we are going to capitalize on is the difference between these two options. And you can see that the 435 call will be at the money. So it will have the highest extrinsic value, and that's your short option. So your profits are going to be minimized because of that fact, because of the fact that 435 is going to be at the money, it's going to have the highest extrinsic value. So the difference between the 425 and the 435 is going to be minimum. So therefore, even though you'll see a profit because you have a positive delta, you'll see a profit. You'll see a profit of approximately, 70 into $7, about $490. But it may not be 490, it may be like 300 or 350 because of the fact that the 435 call will be at the money, and therefore its option prices are going to get inflated, and that's your short call, and so your profits are going to be minimized on this. Whereas if you looked at the 435 call, now we are looking at this one, the 435, 445. If Apple goes up to 435, then your 435 call is going to be at the money. The 445, which was already out of the money, is going to be further out of the money. But because your 435 is at the money, it's going to have the highest extrinsic value. And therefore, and that's your long option. And therefore, the price of that option is going to be inflated, just like the previous example. And so when that is inflated, the difference between the 435 and the 445 is going to be maximized. So that's really where you want to be. You want to be at a place where your long call is at the money because it's going to hold the maximum extrinsic value, and that's because, at the money options for any series are going to have the maximum extrinsic value. So you're really maximizing your profit potential. If the move happens, you're maximizing that with this spread, with this out of the money call spread. So there are, obviously the disadvantage with the out of the money call spread is you're going to start out as theta negative. You can see that you have a theta negative position. But you can get your, if you get your move, then this out of the money bull call spread is going to optimize your profit. It's going to get your profit much quicker, and it will probably be more than this option, just because your long call is at the money and it will hold the maximum value at that point, maximum extrinsic value, and therefore, even your investment into the trade is less. So therefore, all of those factors combined is going to give you a better return on your margin. So that's the two comparisons. Always remember, at the money options will always have the most extrinsic value. Regardless of what expiry series you choose, at the money options will always have the maximum extrinsic value. And so if you're putting on a spread, you want to see that your long position, your long option comes to at the money. And if you're always thinking of, okay, when is a good time to exit your trade, it's always a good time to exit your trade when your long call, or your long put, whatever the case might be, when your long option is at the money, because at that point it's holding the maximum extrinsic value. So you've maximized the value of that option at that point. So hopefully this video was helpful. If you have any questions, please send me an email, info@optiontiger.com. Thank you.